evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 15th of June, 2021, which is the day before the Fed. The return of the Fed, the revenge of the Fed, the onset of the Fed, whatever you want to call it. The Federal Reserve began their meeting, and they will be announcing the policy, or mainly lack of change thereof. They won't be raising interest rates. It would shock the market. They won't be doing that, but they will be issuing guidance, and they will be making statements, and there could be headlines and fireworks in those statements, specifically if the Fed discusses bond tapering or lowering their purchase program or anything to do outside of transitory inflation, which is a kind of a code word for short-term inflation versus permanent or longer-term inflation. That will be the battle. That's where the market will move on the headline and what they say and how they react or speak to the market. It could be the case that they want to cool inflation or at least cool the market, and what we're looking at right here is the S&P. Now that's the S&P futures. We'll actually shift that quickly to the SPX, just to get a sense of where the market is. And this is the period from the end of COVID. So COVID, the market bottom, relatively steady uptrend, but it's clearly gotten overheated. And if you think about markets like this, about, pardon the nerd word, but linear regression, or at least normal growth rates, we'll just redraw this quickly, getting a sense of what we're looking at. All it is a kind of an average price. As the market rises, this might be considered over or under fair value, and we have kind of log or linear growth rates. That might be a trend line channel. You might want to be more specific if you add the linear expression or the linear regression models, 50 or 100. That's done up here just for everybody to look at. We'll actually do that kind of quickly, but linear regression is a way to look at the normal growth rate. Now here's what I'm trying to communicate. We are above, especially if we're looking at this on a little bit of a shorter term basis. We're above them. Now what does that mean? It means the Fed or the market or the probabilities or the way we're looking at this has a little bit better shot to come down than up, because the market, like everything else, is a little bit overheated. So let's think of it like this. There's the trend line. We're talking bigger picture. We're just sort of thinking out loud about the Fed is all I'm really doing here. So when a market deviates or goes a little bit too far from the linear or the log normal fair value, if you will, which does have a rising trend to it, but this is considered over fair value, under fair value, and this is big picture concepts, big picture discussions. So we're not talking about the next day or the next week, but in general. So each time the market has pierced under the line or gotten near it, that's been a decent short-term buy opportunity. These being the end of 2018 and the beginning of 2020. But since 2021, we've been above that fair or log normal or stable growth rate. Where is it located currently? 3,600. Might the market get there? Absolutely. Might it happen in one fell swoop? Probably not. But that's where we'll be going into the Federal Reserve meeting and thinking and planning and setting trades up. And again, I am talking broad picture here, beyond the sense of the next couple of sessions, because we're going to know what the Fed says, does, talks, prognosticates, and how many times they say the word transitory. And we'll just keep track of that on the intraday basis. So that will be tomorrow. That could be a big market driving event. While we're on this big picture, let's go ahead and keep the theme of the video the night before the Fed. And we'll know a little bit more clearly tomorrow. So they could easily talk the market down. And that would be the probability, taking account this overbought, overextended type of scenario. And for the Nasdaq, that's just above the 14,100 level. Again, plays to the short side might have a little bit more favor or snapback on that rubber band. The Dow mini futures, or the Dow Jones itself, has already played a little bit. I have to zoom in all the way here to see that the last 1, 2, 3, 4, 5, 6, 7, about 7 sessions have been to the downside. And that is on a little bit higher volume. So we are getting some sell-offs or some bearish movement in the Dow. Part of it part of it is Caterpillar. Now that's that concept that strong stocks get stronger, but they have rubber band snapbacks, and patience pays on the put side to get the position on. We don't know when the exact top will take place, but until that happens, the buys or the flags or the retracement trades have a little bit better success in terms of risk control. Not everything that goes up will continue going up. And that again, Caterpillar, we can look just basically back to 2018 with a random rally, continual rally, and then the snapback. So that is in part why, to name a few reasons, why the Dow has pulled off so rapidly, and the Russell is back to the top of its volatility box. So just getting the big picture set up and ready for that Fed. About 2250 is the fair valuation price, and that Russell has a good shot to come from 2350 down to 2250. The bottom of the box is about 2150. And that's nothing more sophisticated than just looking at the highs and the lows and plotting out what I refer to as fair valuation, above fair valuation, and of course under fair valuation. And that does set trades up to the short side or the put side. Wouldn't be doing the market update complete service unless we looked outside the equity market toward what is transitory, which is crude oil. Crude oil, I know it went negative during the coronavirus, but one of the front month contracts, but nonetheless, this is the continual contract, and this is CL. And it is at not all-time highs. That it would not be an all-time high right there from 2018, but coming up above 70, that is quite inflationary, and you're seeing that most likely in the pump, meaning when you fuel up your car or your truck, you're paying a little more money for the gasoline than you did a few months ago, and really at the start or the onset of the pandemic. Gold, which you would think would be a hedge against inflation, this is where things are getting interesting and where the trades are coming into play. Gold steadily increased from about 1,300, peaking at 2,100, and has been downtrending ever since. But it did catch a bounce up to 1,900. So the going thesis is when there is inflation, gold ought to be the hedge. And that just simply isn't the case. Lumber futures are different, which is itself off the highs and pulling back deeply. That's something to watch. That's the argument that inflation's transitory, to see lumber futures down that low. Transitory just means short term as opposed to permanent. So that's what the Fed will be discussing. Again, we'll stop using that word, but that is what we'll be looking at. So is inflation here to stay, and what does the Fed have to say about that? Or are these overheated commodities just, what other word can we use? Temporary would be a better word. Now that's the gold market. We looked at lumber, and we'll look at bonds because that's going to be in focus. The bond market itself, this is the 10-year Treasury note, and we had a stellar rally. This is the pricing of the 10-year Treasury note, bottoming in 2018 with a long-term support. Really, the entire year of 2018 was a bottoming process. 19 into 20 was trend up, and really 20, if I can sort of phrase it that way, 20 into the current 21, half of the year complete, really was a topping and reversal phase. The exact opposite was true in Treasury yields, which is the 10-year Treasury index, that is TNX. And the way that we look at this, when it says 32, that actually is 3.2%. There is 30 or 3% in the Treasury yield. There is 20 or 2%. And let me actually, while we're on this frame, duplicate this drawing and put on the 1% level. And that's just getting a sense of, well, this is how we do trend lines on the bigger picture. So these are just round numbers. 1%, 2%, 3% in the 10-year Treasury yield. And similarly, it peaked. It's the opposite of the bond prices. It peaked in 2018 and has been downtrending into 2020, bottomed itself or has formed a support and rallied up. This is where we were discussing quite a bit earlier in the year about how rapid and the large percentage change going from about 0.5 or 0.6% all the way up to just about 1.8. And the bond yield has fallen lower. And this is where interesting things will happen. And as we finish the video, we will know, you will know, we will all be looking at what the Fed says and how the market reacts, and that includes the bond yields. If inflation is here to stay, one would expect the yield to creep higher. If inflation is temporary and only a short-term variable, you would expect the yields to fall lower. That is what's happening now. And that would be on the flip side, just to be quick on the TLT, that would be bullish on the Treasury price, which is TLT or ZN, 10-year Treasury note. This is Corey Rosenblum with tonight's Theo video update for June the 15th, 2021.